without further ado, we're going to kick off. If you want to ask questions, please do post them in the chat and we'll pick them up at the end. And I promise we hopefully will have time to do at least a couple of questions. So I'm going to kick off today. I'm going to kick off the panel now. We're going to run through, I'm going to start with Faiella, who's from the Banca d'Italia, who's the coordinator of their task force for the G20, which of course the Italians have been chairing on sustainable finance. Then going to turn to Sonja Gibbs from the IIF, who's been running the work there on sustainable finance and specifically on carbon markets. We're going to then have Rachel Ward, who's the Policy Program Director on the investor side from the IIGCC, the Institutional Investor Group on Climate Change. And then Francesco Bicciato, who's from the Italian SIF, the Italian Sustainable Investment Forum. And finally, James Close from who's the head of climate change at NatWest. So a terrific panel. Thank you all for joining. And Ivan, why don't we hand the floor over to you to kick us off this morning? Thank you.
Okay, thanks a lot, Nick. Hello to everybody. Well, I would like to touch upon a bit on the perspective of COP26. So what happened to COP26? It was good, it was bad. You know that there is always disappointment regarding COPs and G20. I don't think that's a big news that this is happening again. Let me start saying that I don't know what's the pulse of 1.5. Definitely we are facing an energy crisis, and that's run the risk to freeze a bit the transition process. Now we have to be blatant and honest and see that, you know, the situation is not helping the transition process. At the same time, climate change is not stopping. We know that the last seven years were the record high in terms of global warming. We know that again, we break the record with 1.11 degrees above the pre-industrial average. And we saw the last year, unfortunately, many extreme weather events in Belgium, in Germany, and in Texas as well, and we are seeing Colorado, the increasing in temperature is having shockingly effect on also on the economy, on the insurance process. So from one side we have this kind of stop from the energy crisis. From the other side, we see that global warming is going on. I mean, it's not interested to our problems on the energy markets. How can we judge all this situation given what happened last year? Personally, I think that it's rather unfair to be disappointed by what happened during the G20 and the COP26. Let me remind to everybody that during the G20, we had this maybe small, but I think not small at all, event of having a working group on sustainable finance, permanent in the G20, that is going to continue the discussion on disclosure, on metrics, on the role of the financial system to have a smooth and orderly transition. And that's now is embedded in the agenda. For example, also the framework working group is going to have the network for greening the financial system using scenario analysis for assessing macro risk from climate. And I think that's a big step. In the G20 Leaders Declaration, we have a reference to carbon neutrality. We have a reference to stop to financing coal-fired power generation. We have a reference to climate finance. I mean, it never happened before. So I think rather a successful G20. What about Glasgow? I think rather a successful conference of the party. In the Glasgow Climate App, we have the agreement to revisit emission in 2022. So we don't have more than 5+ year to revise the NDC, but we have the revision, yearly revision. That's a great, I mean, it's saying 1.5, it's an emergency. There is a commitment to limit unabated coal. I know it's phased down, it's not phased out, but you know, again, there is a reference. And there is again a reestablished commitment to climate finance. So I think that's are the result you can expect from such a conference, no, from such an event. But let me make an example to suggest how in practice I think the COP26 had an effect. I want mention briefly the South African Just Energy Transition Partnership. There you have real money, a bit less than $9 billion in grants and loans that want to face the question of phasing out coal in emerging countries. Emerging countries where coal is important not only as a main source of power production, but also as a very important sector in the economy. I think that's a kind of excellent approach. Maybe in the future, instead of counting on this big meeting, we have to narrow our expectation, targeting this kind of one-to-one agreements, very practical, that want to face all the phase of the transition. So we want to avoid to use that kind of energy source. To avoid that, we have to provide money, even with maybe smart way in terms of the financial instruments, to have new energy fuels that are going to substitute that one. And at the same time, we have to tackle the issues at the social level in terms, for example, of labor market retraining, so on and so forth. So I think that all things considered, I'm rather optimistic, and I think that we will see something like that in the future. And 2/3 of global carbon emission are coming from 20 countries. So working on the right country is going to have a big effect.
Great, thank you very much, Ivan. Yeah, we'll come back, I think, in questions later to how do you finance transition, and the South African example is an important one. Just a reminder to listeners, please do put questions in the chat now. I'll pick them up later. Okay, let's turn to early morning in Washington. Sonja, tell us a little bit about what the IEF perspective on COP was, and specifically I know you've done a huge amount of work on all aspects of the financial service elements, but particularly you've done terrific work on Article 6 and carbon markets. Over to you, Sonja.
Well, thanks so much, Nick. It's a pleasure to be here. And, I have to agree with Ivan. It's definitely a glass, 3/4 full when it comes to COP, and many successes. And from the point of view of the private financial sector, there were so many private sector firms showing up at COP. A lot of work with the Glasgow Financial Alliance for Net Zero, or GFANZ, a tremendous momentum there. And also, of course, the progress on the negotiations on Article 6, the establishment of the International Sustainability Standards Board, progress toward global standards. So a lot to like, although, of course, many challenges ahead. Just for those of you who may not be familiar, the Institute of International Finance is the global association of financial firms, 450 members, 75 countries. About half of our members are from emerging markets, so we have quite a broad perspective on these things. So in that context, the IIF was one of the original sponsors of the Task Force for Scaling Voluntary Carbon Markets, and I'm going to say just a few words about that for people who aren't familiar. So the task force was a private sector-led initiative. So you can think of it like the Task Force on Climate-Related Financial Disclosures, the TCFD. And in fact, both of these initiatives were started up by Mark Carney. So, the goal is to build an efficient and high-integrity voluntary carbon market to help meet the goals of the Paris Agreement. 250 members across the whole carbon markets value chain. Lots of participation as well from NGOs, academics, as well as market participants, so your buyers, your project developers, intermediaries, and so on. So the task force came up with a set of what we call core carbon principles, and those include a taxonomy for carbon credits. You need reference contracts to be able to trade these, market infrastructure, and also, and very importantly, action to clarify the legitimacy of carbon offsetting, enhance market integrity, and of course build demand. And those are important points. And at the end of the day, scaling voluntary carbon markets is to provide a really essential tool for climate action. These markets secure rapid and scalable access to much needed private sector capital for climate solutions anywhere in the world, and particularly emerging markets where a lot of these offset projects are located. Think of rainforests, for example, or soil projects, wind, solar. So there's a lot of benefit in capital flowing to emerging markets that can come from the development of carbon credits. So, however, important to note, voluntary carbon markets can really only deliver integrity if they're built on very strong foundations in terms of quality, impact, transparency, equity. Carbon markets need to be effective in delivering emissions reductions and removals, making sure that credits are based on reliable and credible baselines. So the task force has now passed the baton to the new governance body, which is called the Integrity Council for Voluntary Carbon Markets, the ICVCM. And a lot of the original task force members, including ourselves at the IIF, are playing a role in the governance body and on the executive board. So at the end of the day, carbon markets projects really need to contribute to sustainable development objectives and to be welcomed by and avoid negative impacts for indigenous people, for forest and coastal communities, and, for example, smallholder farmers. So we really need all these stakeholders on board. And in fact, the Integrity Council is now actively seeking to recruit indigenous people as local community members to sit on the board and be part of a stakeholder group. So the key task of the council now is to finalize these core carbon principles, and so at which form the basis of the assessment framework. And the carbon markets are going to require significant expansion in order to deliver on their potential. So under a Paris-aligned scenario, where with so many companies pledging to net zero, in order to meet those goals and to be able to buy and sell and trade carbon credits to help meet the Paris goals, carbon markets would need to expand by a factor of 15 times or more by 2030. So a lot of work to do in building these markets in the near term. So the vision relies on 4 enabling factors. You've got to have the demand. You've got to have integrity in markets. You've got to have infrastructure, and you've got to have the reporting and accounting structure. And these factors will make it easier to navigate carbon markets. And there's a lot of initiatives underway to promote transparency in these markets and support good governance, including, important technology innovations. And James from NatWest may speak about this, like carbon credit tokenization. And these initiatives can really help improve transparency in these markets. So I'll just end here with some key takeaways from COP26 that pertain to carbon markets. Number 1, increased emphasis for corporates to really step up on voluntary action to reduce emissions. You see this in all of the pledges to GFANZ and its component parts, the Net Zero Banking Alliance, the Net Zero Asset Owners Alliance, and so on. And I think also became clear at COP that the private sector action needs to be complemented by appropriate public policy, for example, around carbon pricing, to truly be effective in reducing global emissions. So the growth of a voluntary carbon market in tandem with existing compliance markets with some interoperability ultimately and growing more closely aligned can help set a common baseline for carbon pricing across jurisdictions. And in the run-up to COP27, I think there's really going to be growing pressure on the private sector to put transition plans in place, some of that with the help of voluntary carbon markets, and report on progress. The other big takeaway from COP, of course, is the push to mobilize capital for emerging markets, and that carbon markets, as mentioned, can really be a part of that. So the momentum in carbon markets is really set to continue. In 2021, we had record market volume, close to $1 billion in transactions. And it really underscores that carbon markets are becoming a significant source of finance for green projects around the world and a real driver of innovation. So I'll stop there, Nick, and back over to you.
Thanks, Sonja. Could you just say one thing also about the price of carbon, maybe, because there's a lot of commentary at the moment on the price of carbon and how that links, and maybe the connection between the official markets and the private markets you just referred to.
Yeah, I mean, the price of carbon, I mean, I think it's widely acknowledged that we need some kind of a carbon pricing mechanism, ideally on a kind of a global level. You have different countries that have schemes in place, carbon pricing schemes. Some countries do not. And one benefit of carbon markets is that they can help set this price. And indeed, you've seen prices increasing a little bit, but they are still far below the level they need to be to appropriately price emissions and drive decarbonization. And, you've seen a run up in energy prices over the past year or so. So there's a lot of collective coordinated work to be done in encouraging a real global carbon price that can effectively incentivize emissions reductions.
Great. Okay, no, that's very helpful. And as you know, Sonja, we strongly support the work of the task force and indeed the new Integrity Council. So thank you very much for that. And I encourage all of you listening to take a look at the website on that. Okay, let's move on to Rachel. So Rachel, from the point of view of the investors and in the group you represent, maybe you could say a little bit about what your group is doing and then what your reaction to COP was, and in particular, I guess, the move to set up an international standard setup, particularly the things, I guess you care about, things like disclosure regimes and taxonomies and all those very complicated issues. Over to you, Rachel.
Many thanks, Nick, and good morning, everyone. It's lovely to be able to join you today. So I'm Rachel Ward from IIGCC, the Institutional Investors Group on Climate Change. For those who aren't familiar with us, we are a European membership body for institutional investors taking action on climate change. We're across most European countries. We have 350 plus members, now representing over 51 trillion euros in assets under management. And we support our members across a range of activities, including their own investor practices, how they're incorporating climate change and risk into their decisions, how they're acting as stewards of the holdings they have, in particularly for corporates in heavy emitting sectors, and finally in their advocacy and their engagement with national governments and the international community. And just to start, I'd echo some of the points that Sonja and Ivan have made around the outcomes of COP. Certainly from an investor perspective, we did see a lot of positives come out of Glasgow, notably the push towards a kind of global benchmark for ambition now being around net zero, which makes the direction of travel for policymakers and corporates and investors very clear. And some of the wider outcomes, the negotiations, but also the sectoral agreements, including in quite hard to mitigate sectors, and the focus on the need for greater action and investment in emerging markets and developing countries, also provided very clear directions of travel for investors. But obviously there's still quite a lot of uncertainty as to how and how quickly governments will transition carbon intensive sectors, and this is particularly notable for the pre-2025 and 2030 periods. So from an investor perspective, we're very hopeful that there will be a continued focus on the COP26 goal of collaboration, as this will definitely be required going forwards to ensure that all actors can continue to work together to support a net zero and a climate resilient future. And for investors, part of this will certainly be the evolution of disclosure standards and the role of the ISSB. So I'll speak a little bit to what IIGCC are doing in this area and what we're hoping will come out of the ISSB process. Now, obviously, just as a bit of background, it's important for investors to be able to assess the climate and the wider ESG risks and opportunities which are faced by individual companies. This is both in terms of understanding how these risks and opportunities can impact value, and so it helps investors to make informed capital allocation decisions. And there is significant demand for high quality information, but at the moment there is a range of voluntary reporting frameworks and guidance, and while this has driven innovation, it's also resulted in a lot of fragmentation and inconsistency. So IIGCC are looking at the moment as to how disclosure standards more broadly can be made consistent in order to meet investors' needs, and we're pulling together a broad set of expectations for disclosure standards, which we're looking to centre around 6 key principles. So just to briefly cover these. Firstly, in terms of coverage, we would hope that disclosure standards can cover a very broad range of entities, which would include private companies and even SMEs where this is possible. We'll also be looking for international consistency, again, where this is practicable. Standards, in our view, should build on existing frameworks, particularly the TCFD, and promote much greater comparability over time. We'd also be keen to see the double materiality principle upheld. So this is looking at not just how climate and the environment impact on the company's performance, but also how the company themselves are impacting on the climate and the environment. What we're seeing at the moment is that most disclosure standards focus on company performance and the impacts there, but investors also care about the kind of the quid pro quo and how economic activities are impacting the climate too. The fourth principle is around assessment of net zero alignment. So here we would like to see clarity on how investees will align with net zero. This is across the short, medium and the long term by setting targets in these areas. And we already have work in this area that could support alignment, for example, through the Climate Action 100 plus net zero benchmark criteria. The fifth principle would be around integration with financial accounts. So here, material climate-related risks and opportunities which are discussed in narrative reporting, we feel should be consistent with and reflected in financial reporting. And then finally, we want to support regulatory reporting requirements. So disclosures should support a flow of information across the whole investment chain in order to provide information that other stakeholders will also need to meet their own reporting obligations. And at the moment, what we're seeing is that many investors are calling for one single solution which can build on market-led initiatives to really bring a globally comparable reporting system on sustainability matters to financial markets. And this is why the role of the ISSB will be particularly important. So obviously the ISSB, the International Sustainability Standards Board, was announced during COP26 by the IFRS. And what it's set out as its mandate is to develop standards to establish a common global baseline of disclosures to address the impact of climate and sustainability issues on company valuations. And these standards will hopefully enable companies to provide comprehensive sustainability information. This will facilitate compatibility with jurisdiction-specific requirements as well. So, for example, in the EU, where we have the Corporate Sustainability Reporting Directive, that should be taken into account, as well as similar initiatives in, for example, the Americas and Asia and Australia. And we have a process running at the moment where the ISSB is taking shape. So following its announcement in early November, the IFRS have now started searching for board members and vice chairs, which we hope will be announced shortly. And as soon as these positions have been filled, that means that work can commence with public consultations, which will inform the work plan and the proposals which have already been set out by the Technical Readiness Working Group. So from an investor perspective, it's very important that this work develops rapidly, that a development of a global baseline for reporting standards on sustainability can be put in place. From our point of view, the most important elements are that this firstly builds on the existing frameworks such as TCFD, that it establishes a really ambitious global baseline so that we bring laggards up to minimum standards, and that it helps to start moving towards less fragmentation and more harmonisation globally. So I'll leave it there. Thank you very much.
Thanks, Rachel. Well, you raise an enormous number of important and complicated issues. I've heard that phrase, global baseline, quite a lot in this town, Brussels, where I am today. So I'm going to come back later and ask you a question about that. But I want to hear first from our other two speakers. So let's turn now to Francesco from the CIF. So Francesco, you've got, I think, a mixture of financial firms, and I think you were saying some of the civil society sector in Italy as members of CIF. So what's your takeaway from COP and where we're heading?
Yes, thank you, Nick. So my judgments on COP26 is rather positive. Like Ivan and Sonja also mentioned before, I think that the results is rather acceptable, even if the success of the conference will be measurable on the extent to which commitments will be put in motion in the next months. Of course, we have to check what will happen. What is quite interesting is that the role of investors, institutional investors, and not only, is crucial right now. Even they are facing a complex structure of upcoming climate-related regulation and their implementation phase, that will set the framework for the sustainable investment aimed at shifting to a new path of sustainable development. To be effective, we can say that the regulation promoted by the EU policy, especially by the EU policy makers, need to be coordinated among them and operate in an harmonic system. This is an important challenge, and I think. Of course, the most important regulation are CSRD and taxonomy regulation and sustainable financial disclosure regulation, and that they will affect the SRI market, and I think that it's quite important to adapt this new regulation to the reality of the market. I mean, this is something that maybe sometimes there is a mismatch from the theoretical, juridical policies and what it is the real life, we can say, in the market. Another important issue is the social issue. I mean, that there is no climate objective in our point of view without social goals. Just transition and social issues advance as critical factors for enabling a successful shift to a net zero and resilient economy. Even mentioned before the case of South Africa, which is quite interesting because it's a case where USA, UK, France, and Germany agreed to mobilize these 8.5 billion for South Africa, but the other side, South Africa has agreed to decarbonize its coal-dependent power sector while protecting about 100,000 people working in the industry. I mean, we can say that it is an example of good international cooperation and of good participation and collaboration, which is the only way to really fight the problem of global warming. So another couple of considerations that for our point of view are quite important. The first one is just transition. Just transition is, I mean, that the most important goal that we have in front of us, and what we can say is that there are 5 priorities that we have to underline. The first one, that we have to support transition policy and regulation. The second is integrate the just transition in the net zero plans. And the third is recognize the crucial role of dialogue and participation. 4, focus on emerging and developing economies, and the last one is tailored financial instrument and mechanism. Here we have a tremendous increase of green bond and sustainability bond, for example, which are very interesting tools, even because we have from one side green bond principle, from the other side green bond standard from European Commission. So we can say that we can address the green finance towards a clear direction. Even the problem that we are facing right now at European level regarding the gas and the nuclear as a green or not green energy, but a part of this, there is a framework that can guide the investors. Finally, we have some opportunities for climate action and the practical step for investors. The first one is direct capital to adaptation activities. This is more important than, in my view, mitigation activity. Developed countries still fail their commitments to provide 100 billion per year to developing countries. From this point of view, it's not enough. It's not enough. In the hypothesis of IPCC, we are talking about a need, an estimate of $1 trillion that per year that are important to put on the table. And now the situation is a little bit not completely positive. During COP26, the Secretary General of the United Nations, Antonio Guterres, called for 50% of this climate financing to be aimed at adaptation rather than mitigation. So I think that this is quite important, and it is a challenge for COP27. The second important issue is the engagement. Engagement, in our point of view, is one of the most important strategy that we have to put in place. Lead investing companies to account for their own science-based target and engage with those that do not disclose their climate goals. There are many examples, for example, of this campaign, of a successful campaign like Carbon Disclosure Project, for example, Shareholders for Change from the other side, Climate Action 100+. So it's quite important that this kind of dialogue aligned around the same principle, SDG from one side, but also what the EU policies is leading. The last point is the leverage innovative networks and organizations. And I think that James maybe will talk about the Global Financial Alliance for Net Zero. Yeah, I just mentioned what we are doing in Italy. Italian Sustainable Forum represents around 135 members. It is a sort of point of reference in Italy for SRI market. What is quite interesting for us is the multi-stakeholder nature of forum. We are 70% of financial representative of financial sector, so asset managers, banks, insurance company, pension fund, banking foundation, etc. But also 30% of civil society, so NGO, trade union, etc. Which is quite important because in our from our point of view, just the dialogue is between different stakeholders in the society can improve the situation. Of course, at European level, we have EuroCIF, which is the organization based in Brussels, which is composed by the CIF, Sustainable Investment Forum of different countries, UK, Germany, France, Spain, Ireland, etc., etc. In conclusion, I would like just to mention the Yes Generation Italy that was founded last year by Borsa Italiana, Italian Stock Exchange, Italian Sustainable Investment Forum, and Italian Banking Insurance and Finance Federation, FEBAF, with the aim to allow the Italian financial community to have an active role in the promotion of positioning Italy as an excellent in terms of sustainable finance, both nationally and internationally. The initiative represents Italy in the context of the International Network of Financial Center for Sustainability, FC4S. And I think that there are interesting, we can say, initiative that we will put in place in the next months. Thank you very much.
Thank you, Francesco. Yes, I mean, by the way, we have excellent collaboration with the industry in Italy, led by FEBAF and FC4S as well. So that's very welcome to hear. Okay, again, a reminder, please do ask questions. I can see we've got a few questions coming in, mostly on carbon. You'll be pleased to see, Sonja. So James, over to you. Thank you for NatWest's sponsorship and support in Glasgow of the Green Horizon Summit and for your commitments to net zero. So over to you for the perspective of one of the key GFANZ members.
Thank you very much. Always difficult to go last on a panel like this, but delighted to give some impressions of GFANZ and the impact it can make. But I thought it's worth framing this in the size of the problem that we're dealing with. I think we're at 52 gigatons of CO2 equivalent across all greenhouse gases of emissions per year at the moment, 2022 or 2021 latest data. We've got to halve that to 26 by 2030 to be on a 1.5 degree trajectory. The commitments coming into Glasgow were 4 gigatons through the NDC of that 52. There's maybe another 5 or 6 coming from the Glasgow breakthroughs in deforestation, methane, and also coal. So, at most, we can see 10 gigatons of the 26 gigatons of reduction that's required, which means that and that's obviously got to be implemented. But there's another 16 that hasn't yet been identified. So that is the scale of the challenge that we're facing. And the financing that's going to be required to facilitate that transition is enormous. And, you know, you hear lots of huge numbers, but all we know is that it's very, very big indeed. And I think what Glasgow also showed us that many of the political levers have been pulled already. So we've got really ambitious NDCs from the EU and the UK. It's hard to imagine that they can go much faster than they're committing to at the moment. The US, very welcome back into the UNFCCC fold, of course, but Biden's plans are mired in the Senate and held up by one senator from West Virginia. And there must be questions about how the legislative program in the US is going to work. There's obviously lots of other levers to pull within the US, but the politics there are going to be quite difficult from now onwards. And of course, the other big emitter, China, is really kept its powder dry at Glasgow, and won't really be influenced very much by the external environment. So all of that leaves us with really the role of finance being central to the transition. And I think that's why there is a great opportunity and huge responsibility for all of us in that finance community to think about what we can do to mobilize our finance for net zero. And the good news is that that business and finance turned up at the COP like never before. And I've been to many of these COPs, and I've, as both a person from business and also a multilateral when I was working for the World Bank, that it's always felt as though business and finance have been observers. But this COP, they were definitely participants and saw ourselves as part of the solution, and no more so than GFANZ. And I was really fortunate to be part of the GFANZ breakfast, which got together representative of the $130 trillion worth of finance that's committed to GFANZ, and also finance ministers under the supervision of Mark Carney, who's done a quite brilliant job in mobilizing this finance and these commitments. You know, finance ministers were there, including Rishi Sunak and Janet Yellen, finance minister from Saudi Arabia, and also from Egypt, which is, you know, obviously demonstrating developed and developing countries, and also the whole cross-section of the finance sector, from asset owners to asset managers to banks. I have to say, it was really quite an inspiring event, because it was clear that this money is available. We've just got to find a mechanism to mobilize it. And that, I think, is what sits around the GFANZ program that's going to take place over the course of the next year, and some changes in that. And I'll go through some of the detail around it. But GFANZ is a membership organization with a total of 450 firms in October 2021, with $130 trillion of financial asset across those member firms and representing 45 countries. So it really does give breadth and depth. The work that's been done to date have been around a call to action to get finance leaders to do more for climate action, and that the GFANZ mobilization is a demonstration of that, and how the financial system can ensure that public and private capital are working hand in hand with public policy to accelerate the transition. And also demonstrating the progress across asset managers, asset owners and banks around transformation. And all of that's come together in a mobilization statement of support, which brings forward this collective movement, really, to enable finance to flow. And I think the one observation I would make and tie into what other speakers have said is that there was a little frustration from developing countries and emerging markets that although that 130 trillion is presented as available, the mechanisms to enable that to flow in the less creditworthy countries aren't really working as effectively as they should. And we certainly need to fix that ahead of COP27, which will of course be hosted by Egypt, and it will be an African COP, and will really put the focus on mobilizing finance for developing countries, and particularly helping the poorest and most vulnerable protect them from the impact of climate change. But so the GFANZ sort of was born ahead of COP, and now is really growing up after the COP. And of course, Mark Carney was very much the architect of all of this and the driver for it. But Michael Bloomberg has joined as co-chair of GFANZ. He's obviously the UN Special Envoy for Climate Action and brings a wealth of experience and knowledge, which I think will be extremely valuable. And Mary Shapiro, who's the former SEC chairman and head of the Secretariat and the Task Force for Climate-Related Disclosures, will serve as the vice chair, along with Nigel Topping as well, who'll be representing the Race to Zero from the UK COP presidency. And I think all of that strengthens the coordination mechanism between GFANZ and the sectoral commitments. And I think that's going to be very important, and it'll all be staffed up through a permanent secretariat. I think that this will enable GFANZ to be a major force in rewiring the financial system. There's already huge brand recognition and a lot of policy advocacy coming from the financial actors, and finance is very firmly now part of the solution. But there's also some headwinds as well. I think there's still an enormous amount to do on by financial players on fossil fuels and the position on fossil fuels. There is this misperception that the money is available today. We're going to have to figure out how to make that money work with appropriate returns. There's a sort of proliferation of all of these acronyms that can often create some confusion. But it can't just be about the finance. There has to be a policy void that's closed. And I think that's where we re-engage with the political actors to make sure that we have got that policy piece, and therefore we can reinvigorate that political lever. And I just say, one final thing before I close, which is that, there is a really quite well-structured work stream approach. There's 3 work streams. There's a net zero implementation for financial institutions, which comprises the sectoral pathways and real economy transition plans, and also work on a portfolio alignment measure. Each of those is co-chaired by 3 representatives from banks, asset managers and asset owners. And my chief executive sits on the real economy transition plan with the chief executive of London Stock Exchange Group and AXA. And we have a very active conversation about what we're going to do to promote real economy transitions and make clear to those who are actually investing in and managing the transitions that the money is available and how it's going to be mobilized. And then the second area is the net zero public policy, creating the public policy environment to enable that money to flow. And finally, the mobilization of capital to emerging and markets in developing countries. And I think all that creates a really powerful framework for action. I think it's great to see so many organizations involved, and hopefully more and more will engage and really align with the ambition of getting to net zero by 2050, but also setting the 2030 interim targets so that we can get back to that point where we're closing the gap between the 52 gigatons and the 26 gigatons that we need to get to by 2030.
Great, thank you, James, and very exciting about GFANZ's hugely ambitious agenda you have. I guess as we're focusing on finance today, the elephant in the room in any discussion about finance is regulation. And you've all, I think, touched on it in some aspect. And the question then is alignment of regulation. And I wonder, maybe Ivan, you can kick off, because I know you've been looking at this in the G20. How do you ensure that regulation doesn't create barriers to cross-border investment flows, in particular into emerging markets, I think, when you're trying to create, quite understandably, high standards, as Rachel talked about, in terms of disclosure and taxonomy. So one investor told me the other day that they are tracking 109 taxonomies around the world. So that's a fragmentation of regulation, an issue which we've seen before in our sector. How do you, and I ask you first, Ivan, as a kind of the public sector representative, how do you avoid fragmentation, actually probably inadvertently creating barriers to cross-border flows? And then I'll ask those of you from the private sector, for quickly, what is your top priority for regulatory solutions in this space? But Ivan, can you maybe kick us off? Sorry, all of you can try and keep it as briefly as possible. We only have about 10 minutes left.
let me start saying that it's not possible to think about a standardization of the taxonomies or a benchmark standardization. When we are referring to a baseline, and that's what the Sustainable Finance Working Group proposed in its roadmap, is to have some common characteristics. So the taxonomies should be tailor-made because each country has different needs and the transition is going to be different. I mean, the transition in China is completely different from the transition in Italy, for example. That's clear, no? I mean, it's because energy use is still growing there while it's plateauing here, because the energy mix is completely different, and the kind of importance, for example, of carbon intensive industry there is different from here. So that's, I think it's an important starting point. But that said, the principles that inspire the taxonomies should be comparable, science-based. In that sense, let's say, are brown taxonomies, are green taxonomies? See the situation, you're in Brussels, so you know how the situation is now. For example, for the EU taxonomies, we started with green, but now we have the transition activity. So when then you have to apply this stuff in practice, you learn that, you know, the things are different. So maybe you have in mind an ideal list, but that's not that easy. So that said, the only point I think is that to avoid what you can call a kind of arbitrage, you know, between different and a kind of break on the possibility of having these flows of finance flowing in different countries, is to find that common denominators. I hope that in that sense, the work within the G20 is going to help. I think it's in the interest of everybody, because having the point of the taxonomy is not to be perfect, is to reduce uncertainty. And uncertainty is going to stop the flowing of this finance, in particular for emerging countries that are the countries that need more investment, more resources, because they have a real challenge in the transformation of the energy system. So I think that it's possible to find a way out. The point is that, as you can see also in Brussels, sometimes the discussion, they ask for this classification to be science-based, but are not science-based at all. I would say are political-based, and that's an issue. So we have to stick as much as possible. In the chat, someone was mentioning the SBTI, so this science-based target system. I think that that's honestly the way to go. Not specifically the SBTI, because it's super. I mean, it's very difficult to achieve such a high standard. But at least to find a common set of standards where we know that we are, in a sense, the work also of Sonja was in the same direction. Find a standard for the taxonomy, find the standard where carbon voluntary market can work, and then the market is going to do the rest.
Is the intention to have a common taxonomy or set of principles ready for COP27?
Well, the G20 should work. In the roadmap of sustainable finance, we had this set of basic principles. How this is going to be translated in practice, it depends, because it depends also on the priorities of the Indonesian presidency this year.
Okay. Sonja, then, I mean, an obvious question for you, if you don't mind, as our American representative today. I know you're not an American organization, but you know, when you're sitting in Washington and you hear all this talk about global alignment and common taxonomies and disclosure regimes, a lot of the world looks to Washington, I think, as James was saying, and it looks sort of deadlocked in Washington, doesn't it? So what are your concerns about achieving global alignment in regulation from your perspective?
So really, it's in three areas that alignment is just so critical, particularly when you think about the task of mobilizing global capital, which has to smoothly and effectively flow across borders. And as Ivan mentioned, including to emerging and developing economies. So you need a common rule book. Three areas, really. One around climate risk. Okay, so in areas like scenario analysis, stress testing, you can't have 40 different rule books, you know, in different jurisdictions and expect, you know, global firms to be able to operate efficiently. You can't be doing, you know, 60 different types of stress testing. So the key really in that area is for regulators and supervisors to focus in areas like microprudential, the traditional safety and soundness mandate, macroprudential financial stability, rather than the kind of steering capital task, which is properly left to policymakers and is very jurisdiction specific. Alignment and disclosure, we've already talked about that. You know, the ISSB absolutely critical here, finding some way to have a building block approach that can accommodate different approaches to materiality, because I think it's very difficult to get to a perfect agreement on exactly how to deal with that question. And then as I've mentioned, the taxonomy question, I think the key here is going to be some kind of interoperability, right? So you have the EU and China in discussions around taxonomy. That process is important. And frankly, in the US, the approach is simply different. The concept of coming up with a very detailed and prescriptive, taxonomy is just a bit foreign, as it were. But that said, there's a great deal happening at the SEC. There's going to be increased disclosure requirements, including in areas like human capital, likely based on a TCFD type of approach, but I think less ambitious in scope. So the key is going to try to rally as many jurisdictions as possible around what the ISSB ultimately comes up with.
Yeah, and I guess the challenge from the EU perspective is if you put in the standard approach of equivalence, meaning basically full of the EU detailed rules, and that's not going to work with the US or indeed possibly other jurisdictions. So that needs some flexibility built in. Can I just quickly, whilst you have the mic, Sonja, there's a couple of questions about carbon standards as well in the chat. Can you quickly answer what's the potential for getting common approach to the treatment of carbon offsets?
The SBTI, and I want to say first of all that SBTI has been an integral part of the
science-based targets.
The Science-Based Targets Initiative has a number of constituent groups, and many of these have been really supportive of the work of the task force and so on. And I think it comes down to, part of it is sort of a semantic issue, right? SBTI is taking a cautious line on carbon credits, and that's in keeping with all the work that SBTI has done over the years. But our view is that companies need to put in place credible net zero plans, publicly disclose them with detailed transition plans and reporting progress against these plans, so that the mitigation hierarchy is something like reduce, report, and only then offset. Offsetting the use of carbon credits has a small but important part to play in net zero transition. So, SBTI does recognize the role of carbon markets, and they call it, I think, additional investments and mitigation activities above and beyond their value chains. But that's really kind of getting at the area of carbon markets. So while they take a cautious approach, it's been a very constructive dialogue, and we look forward to continuing to working with them.
Okay, thanks. And for maybe all three of you, Rachel, Francesco, and James, what on this question of regulation and alignment, what are the priority areas where you want to see alignment, which will then help you as practitioners to particularly deliver transition financing and deliver to emerging markets? Maybe Rachel first. You already talked a bit about disclosure. You didn't talk about taxonomy. I'm not going to. You don't have to answer the gas versus nuclear question, Rachel, but you could maybe more generally on alignment and taxonomy. What's the investor view?
Thanks, Nick. Very quickly on gas and nuclear, I can draw the attention of the audience to an open letter that IIGCC published a couple of weeks ago on this question, which is on our website. So where we strongly oppose the inclusion of gas. We're still discussing with our members the question of nuclear. We do have a clear position there. But just more broadly on regulation and the move towards standardisation, investors do cite fragmentation very frequently as a key barrier to effectively assessing exposure to climate-related risks and opportunities at the national, the European and the global level. So certainly what we're hoping for, across a range of policy areas ideally, but disclosure is really one of the key ones, is that ultimately we can develop a set of standards as Ivan outlined that provide that common global ambitious baseline, but ultimately what's important is how that is then implemented into regulation at the national and in the EU's case the regional level, because ultimately the implemented regulation is what then guides the investors' final decision making. So there's two tracks really that we will be paying close attention to: the development of the standards and the political discourse, but then how they're implemented on the ground. Thanks.
Yeah, all said. Francesco?
Listen, a couple of considerations. The first one, that the alignment is crucial, but the alignment on what? I mean, this is quite important. So we have some point of reference like SDGs, Agenda 2030, and Global Compact, or other point of reference that could be very useful to guide this kind of alignment. One of the most important issues is the private-public alignment. In many cases, private sector, in terms of investors, is more advanced than the public sector. In my point of view, I mean that the evolution of sustainable finance in the last year was quite interesting and more faster than the public one. So we have to find new form of private-public alignment and the partnership, especially now that we have to manage the resources coming from the recovery plan, and so it's very important. The last consideration is that we need a reform of international cooperation. We have to understand that this matter of climate emergency and the economic emergency is facing only at the worldwide level. I mean, that is nonsense that the EU has a policy, China another one, or US another one. I mean that just multilateral and bilateral cooperation could be a solution. So we can overcome this fragmentation only if you align the international cooperation policies.
Yeah, well said. James, you have the last word.
Yeah, thank you, Bo. Just very quickly, really, I think UK announced the mandatory net zero transition plans. I think we've got to make those practical, realistic and oriented towards the real economy, and I think we need good practice guidance that can be consistently applied across the whole globe. I mean, and let's convert this into a consistent approach, and GFANZ can play a role as well as every other actor who's on this call.
Great. Yes, consistency in application is the conclusion. Terrific. Well, look, I apologize if we've overrun slightly. Thank you all very much for an excellent series of presentations. Perhaps a particular thanks to Sonja for getting up in the middle of the night to do it. And we look forward to more success in the Anglo-Italian chairmanship of COP, and see you all, I guess, in Cairo. So thank you all for speaking, and thank you all for listening, and thank you for your questions. Have a good day. Bye-bye.
Thanks.
Bye-bye.
Bye-bye.
Bye-bye, everybody.
Pleasure.
Ciao,
Bye-bye.
ciao.
Ciao, ciao.
Ciao.